Now, you've probably heard the argument 100 times. Cut business taxes and prices will fall. Cut company taxes and life gets more affordable. It sounds logical and it sounds clean, and honestly, it sounds right. But what if that argument, as satisfying as it is, was almost entirely wrong? Today we're rounding out an accidental 3-part series on taxation and the cost of living. And in this episode, we're asking the most important question yet. Does lowering taxes actually lower prices for you, the consumer? Now, I think the answer is more complicated and more interesting than you might expect. My name is Richard and welcome to Ron's Industries, the industry blog for investors where we're pro-wealth, pro-growth and pro-business. And we're going to be looking at why lowering taxes probably wouldn't lower the cost for businesses or the consumer. Now, before we dive in, let's do a lightning fast recap from the previous 2 episodes because context here is literally everything. In part 1, we looked at government debt and the hidden costs buried inside your taxes. In part 2, we broke down which taxes actually raise the cost of goods and which ones don't. Now, here's the key takeaway from that analysis. Personal income tax has essentially no direct effect on the price of goods. Why? Because your wage is the cost borne of the individual, not the business pricing its product. Company taxes, on the other hand, do affect prices because they feed directly into the cost of doing business. And when the cost of doing business goes up, those costs get passed down the chain. Eventually, they end up landing on you. Now, if that's how it works on the way up, if raising company taxes can push prices higher, then surely the reverse must be true. Surely cutting company taxes must push prices lower. Now, that's the question. And here's where it gets really interesting. Let's talk about how prices actually work in the real world, not just in a textbook, not just in a model, in the actual market. Now, here's the reality. A business can name any price it wants, but the market decides whether that price actually survives. If you're in the computer space, then you'll be seeing this firsthand right now. Now, imagine a business lists a product at $100. If a customer looks at it and walks away, if the market rejects it, then the product fails. Maybe the business fails along with it. But if the customer buys it, the market has just confirmed that price. It's accepted, and then it sticks. And here's the critical part. Once a price is actually accepted, there's almost no natural force that brings it back down. Let's think about energy prices. When the cost of crude oil goes up, the prices at the pump go up with it. But when oil prices ease off, does your energy bill or your fuel bill immediately drop back to where it was 2 years ago? Depending on where you are, it may, but in other places it could also be extremely rare. And even when it does, it can take time. And then when it does after that, it's usually never quite the same. Now, the cost of petrol and diesel compared against crude oil is one such case. Although oil itself reached its high in the middle of 2022 and then retreated afterwards, now down to prices that were seen in around about 2018, the cost at the pump hasn't necessarily retreated. For people in Melbourne, we still see 2022 prices often 60 to 70 cents higher per litre than stations just around the corner. This price spread now showing pricing between $2.20 and $1.50 per litre is evidence of that price acceptance. Or think about fast food. For a while, the market will absorb those higher prices. People will grumble and complain, but they keep buying. Eventually, the servings get smaller. Eventually, and we've seen this recently, the price crosses a threshold where the value exchange breaks down. People stop going. And that's when prices get forced down. That's when the pressure comes back on the business. So here's the logical question that follows. If the market has already accepted the price of something, why would any business voluntarily lower it? Now, the answer is they usually don't. They wouldn't. And this is exactly why cutting company taxes on its own doesn't automatically make your groceries or your rent or your fuel any cheaper. Let's say a government cuts the corporate tax rate. A business that was paying 30% tax on profit now pays 25%. That's real money back in the business. But what happens to it? Does the CEO call a board meeting and say, let's cut our prices by 5% and pass the savings on to our customers? I dare say that is something that rarely ever happens. That money is usually going to get absorbed internally. It's going to go towards things such as additional marketing to grow market share or employee bonuses and retention schemes. It's going to go into research and development for the next product, upgrading agent equipment and infrastructure, or building cash reserves for uncertain times. The list is endless. Now, these are all valid, rational things for a business to do with extra profit. None of them are actually inherently bad, but none of them directly lower the price tag on the shelf. So if you were hoping that a tax cut would immediately shave a few dollars off your weekly shopping, data and psychology says, don't hold your breath. The immediate effect of a tax cut on consumer prices is usually going to be close to zero. And this is crucial because now we need to look at the second order effect. That's where we start to see an entirely different story. So here's where things get genuinely powerful. If you watched part 2, you'll remember we talked about second order effects. What happens after businesses have had time to respond to a change in the rules? Now, when taxes go up, the immediate effect might be small. But once businesses react, once they adjust their pricing, their hiring, their supply chains, the ripple effect on the economy and the consumer prices can be significant. Now, the same logic applies in reverse, but the mechanism is entirely different. A drop in company tax that translates to even 1% more in net profit might seem like a small thing. But for an entrepreneur sitting on a business idea, someone weighing up whether to take the risk and start something new, that 1% could be the difference between let's do this and it's not worth it. And that new business forming, that new competitor that is entering the market, is where the consumer starts to win. Now, this is the core insight that ties everything together. Taxation and tax rates are just one set of rules in the broader business rulebook. They sit alongside regulation, labor laws, trade policy, and dozens of other variables that determine whether a business chooses to operate in a given country, industry, or a market as a whole. And the fundamental question for any business is simple. Where are the best conditions to start and grow? Now, a country with punishing tax rates and heavy regulatory burden will see fewer businesses. A country that creates favorable conditions will see more. And here's why that matters for you. Because more businesses competing for the same customers will compete on lower prices. And when businesses are fighting over your attention and your wallet, when a new competitor can enter the market with lower overhead and genuinely have a potential to undercut the existing players or chase a new customer, that competition is the deflationary force we need inside an otherwise inflationary world. Now, less overhead means a new business can price aggressively and still be profitable. Aggressive pricing from new entrants forces existing players to respond. Existing players respond by trimming margins, improving value, or by innovating. And the customer wins at the margins, quite literally. This is why competition is not just good for the economy in some abstract sense. Competition is the mechanism that stops the cost of living from spiraling completely out of control. It is the check. It is the balance. It is the force that keeps prices honest. And without it, established players can raise prices. Consumers have no alternative, and price acceptance becomes guaranteed. Not because it's fair, but because there's nowhere else to go. So does lowering taxes lower prices? Well, here's the honest answer. Not directly, not immediately, and certainly not automatically. But in the right regulatory and tax environment, one that genuinely makes it easier for businesses to start, to grow, and then to compete, lower taxes can absolutely lead to lower prices over time. Not because businesses pass savings on out of goodwill, but because competition forces them to. Now, taxation is necessary. No one seriously argues otherwise. Governments need revenue to function, but taxation is only one lever amongst many. It's one part of a much larger rulebook that governs how businesses operate, where they choose to invest, and how aggressively they can compete. The conclusion of this entire series is really this: for people to truly get ahead, for the cost of living to remain manageable, the businesses and industries that supply our goods and services need to be allowed to operate and to flourish. They need room to compete. Not every business will win. Statistically, some will always fail. Statistically, most will. But that failure, that process of competition, is exactly what protects the rest of us. It's the mechanism that stops any one player from having it too easy for too long. Now, finally, taxes matter, regulation matters, but competition is the engine underneath all of it. And if you followed this series from the start, I want to thank you. Drop your thoughts in the comments below. I'd love to know where you agree and where you push back and what topic you'd like me to tackle next. And if you're new here, parts 1 and 2 can be found right here. Start there, it'll all make a lot more sense. But for now, thanks for watching. Until next time.